An average person sees price going up and down, but what a professional trader is seeing is a war between two forces, supply and demand. In other words, the sellers and the buyers. But what if you could predict the winner before the fight even begins? In this video, I'm going to give you a sniper's manual. We are going to break down supply and demand in 4 simple steps, guys. By the end of this video, you won't just see charts, you will see a map where the big money is about to enter or exit the market to drive price up or down. Now let's get straight into it. Step number 1. What are supply and demand zones? Supply and demand zones are points in the chart where buyers or sellers get aggressively excited to buy or sell. Let me break it down for you. A supply zone is a price where sellers aggressively get excited to sell their asset because they believe it's a premium price to sell it and get more profit. While demand zone is a price where buyers aggressively get excited to buy their asset because they believe it is a premium price to buy at a cheaper price and sell expensive later. Now, think of this as a tomato market. Imagine you're in a tomato market. If the price of tomato cost $1 per kilogram presently, right? And yesterday the price was $2 per kilogram, buyers will eagerly and quickly buy the tomato in the market, anticipating that the market will get higher and they will expect to sell it at a higher price above the $1 they bought it. All right, so the more buyers buy the tomatoes, the more tomatoes become scarce in the market, and the more the price of the tomatoes will increase if tomato becomes scarce in the market. Now the buyers that have bought it for $1, right, will wait until when the price gets to, let's say, $3, which they feel is a premium price for them to make profit. Now the buyers will then pose as sellers, selling the tomato they initially bought for $1 at $3 now that tomato is scarce, thereby creating a supply zone. So initially they were the ones creating the demand zone, and now when there was no tomato in the market, they pose as sellers and create a supply zone to supply tomatoes to the buyers that wants to buy at a premium price. Now that you have understood the concept behind supply and demand, let's move to step 2. How to spot supply and demand zones in the chart. Right? Demand zone is the last bearish candle before the bullish aggressive move upwards. Now, as you can see on this chart, this is, or should I say, this was the last, sorry, let me indicate it properly for you. This was the last bearish candle before the bullish move upwards. So it is safe for us to call this zone or this place a demand zone, a zone where buyers actually buy at a cheaper price. In the case of a supply zone is the last bullish candle before an aggressive move to the downward side, right? So as you can see over here, this is the supply zone. So it is safe for us to mark this area as our supply zone before the aggressive bearish move to the downside. I hope it is clear. However, not all supply and demand zones are considered valid. There are factors to be considered before confirming the validity of a supply or demand zone. We are going to treat the factors one after the other right now. Factor number 1, a supply or demand zone must have a fair value gap. A supply or demand zone must have a fair value gap. Now, the question probably running through your mind is, what is a fair value gap? Now, I want you to imagine price moving on a normal stair-step pattern. Suddenly, price skipped 3 steps at once, leaving a visible gap between the first step and where it lands. That gap in between, I'm talking about this gap now. This gap in between is your fair value gap. Fair value gap is caused when too many buyers buy at once or too many sellers sell at once. This makes price jump up and skip too many price level. On a bullish scenario, you're going to see something like this. You're going to see something like this, normal price movement, and suddenly the price will skip a lot of steps, okay, before it continues. Now, the market, one thing about the market is that it does not like these gaps. The market feels as if it has an unfinished business over this area, right? The market feels as if there's an unfinished business. There are lots of buyers and sellers over here that have not been attended to. All right, so it will always come back to fill these gaps before it continues moving. All right, this is fair value gap. Now on the chart, this is how fair value gap looks like. All right, this is how fair value gap look like. The first candle, right? The first candle, second candle, and third candle. If you notice, you're going to see that there's a space in between the first candle and the third candle. Now this is what we refer to as fair value gap. All right, and on a bearish scenario, the fair value gap looks like this. All right, so as you can see, there's a gap between the first candle and the third candle. Now this is your imbalance in the market. Now factor number 2, a supply or demand zone must lead to a break of structure. Another question, what is a break of structure? Now imagine price moving in an uptrend, okay? Then the price forms a pullback, which is a temporal setback, and then the price moved even higher than it was before. Okay, now this pullback and continuation it formed will lead to what we call a break of structure, right? This is what break of structure means. It is like an instance of validation. It is validating the up move, like trying to tell you that the move is in a continuation phase, right? And so same applies to downtrend. On a downtrend example, let me say imagine the price coming back down, and then you got a temporal pullback, and then the price moved even way downwards. Now this place over here is your break of structure, validating the continuation of the downtrend. Now that's factor number 2. A supply or demand zone must lead to a break of structure. Now when you see a fair value gap and a break of structure, you are almost convinced that it's a supply or a demand zone until the third factor occurs. Now what's the third factor? Now, the third factor states that the up move must gradually come down in a demand zone scenario, or the down move must gradually go up in a supply zone scenario. What it means is that after spotting this, okay, after spotting this demand zone, and then the move went up, if the move wants to come down, okay, if the price wants to come down, we don't want to see a very long candlestick breaking this zone over here. No, we don't want to see that. What we want to see is series of candles, all right, series of candles gradually coming down to actually balance the fair value gap over here and anticipate to actually go back up. Now this is what the third factor simply means. Now once these 3 factors are met, all you have to do is wait for price to mitigate the fair value gap and balance the market. The moment price touches the demand zone, it will bounce back. Okay, the moment price touches the demand zone, it will bounce back up, and the moment price touches the supply zone, it will bounce back down. Right, let's have an example of this and see if it's actually going to work or not. So now guys, this is the last candle. Okay, this is the last red candle before the up move, right? And then the last red candle formed a fair value gap over here, and they said it must lead to a break of structure. If you notice something, you're going to see that we came from a downtrend, right? We came from a downtrend and we got a lower high, lower low, right? A lower low and a lower high, a lower low, and now there's a higher high over here, creating a break of structure over here. Now all the factors have been met. All the factors to validate a demand zone have been met. Now all we have to do is draw out a rectangle like I did over here and expect price to come back down after going up. Expect price to come back down tap the fair value gap and the supply zone, and then continue the upward move. Now all we have to do is to mark out our entry, right? So I'm anticipating the entry is gonna start from over here, and then our stop loss is going to be a little bit below the demand area, all right? Expecting that if the price comes back, tap the fair value gap and the demand zone, the price will likely reverse and then we'll take profit. Now let's see how it's going to actually play out. Have you seen? This is clear, precise entry with a very fantastic take profit. All right, now this is how you spot supply and demand zone, and this is how you trade them. Now if you're having any confusion or you need more in-depth on how this strategy work, you can hit me up on my WhatsApp link using the link on the description below. I've dropped my link, and get enrolled in the mastery mentorship class, where you are going to have an independent videos on supply and then demand and any other aspects of trading, including the double confirmation, where you are going to add the strategies with technical analysis indicators to actually confirm your entry. I hope this video helps, and I hope you have a nice day.
More trades don't mean more money. They mean more mistakes. You've proven it to yourself countless times, and still you chase. The market isn't tricking you, you are, and every click is just another confession of weakness.